Welcome back to the part 2 of chapter 8. So we stop at the decision maker's perspective of choosing appropriate inventory method, right? So we know that when factors motivate a company to choose one inventory method over another, so we are curious about what factors has caused the increased popularity of LIFO, right? And then why is LIFO is more popular gradually? And then choosing among the alternative accounting method is a very complex issue. And often such choices are not made in isolation, but in a such way that combining the inventory costing with the depreciation method and pension assumptions and other choices together to meeting a particular objective of the financial reporting of a strategic decision. And then research has also shown that managers sometimes making these choices to maximize their own personal benefits rather than inform external users. Regardless of their motive, the impact of a reported number is an important consideration of the choices that you make. Okay, so first of all, the factors influencing method choices could associate with the physical flow, right? For example, companies often attempt to sell the oldest goods in inventory first. Hence, that we believe FIFO should be the best suits the physical flow in this situation. In other words, the FIFO is most likely to match the physical flow of the inventory with the cost assumption. And if the company is if the inventory sold comes from a mixture of goods acquired at various time, such as with liquid, the average cost method should be more closely to actual physical flow. Such, if for example, you're, cook like a liquid like a Coca-Cola or cooking a soup. So different liquid mixed together, hence that the average cost of goods sold might be a better physical flow, which is matching with your cost assumption. And then, but in another word, it's saying that in reality, very few inventory flow is actually can be explained by LIFO manner, right? But why LIFO is very popular, then I will explain in short. It is not mandatory to choose them, but you have to know that, right? It's not mandatory for us to choose a method that's matching the physical flow, but physical flow does consider as a factor that's influencing your choice. If you consider physical flow is important, matching physical flow with cost flow is one of your objectives. The second factor that we want to talk about could influence in your method choice is income tax and net income relationship. In other words, if a unit cost of inventory changes, the method chosen will have an impact on, first of all, amount of income reported external parties and the amount of tax being paid to IRS and state and local taxing authorities. So when inventory costing is rising, right, and the inventory quantities are not decreasing, then LIFO produce a higher cost of goods sold, hence will result in low net income, right, than other method. And then if you have a lower net income, that can save your tax as well. So hence that using LIFO method, the biggest benefit is the low taxes, pay low because low taxable income. Okay, that's is one reason people choosing LIFO more and more. And so many companies choose LIFO is trying to reduce the income taxes in periods when the prices are rising. And taxes are not reduced permanently, only deferred, because I wanted to talk about called LIFO reverse in short. So the IRS requires company to follow a most important rule called the LIFO conformity rule. So what is the LIFO conformity rule? It means that if a company chooses LIFO to measure taxable income, then you must using LIFO to recording your financial reporting, because financial reporting use LIFO will have low net income, right? And hence that if you take advantage of the tax, then you should show your external users that you were corresponding with lower net income. So when we talk about that, LIFO could also save tax, but not permanently save tax. The tax here is only temporarily delayed. The reason is that there's some phenomenon called the LIFO reserve. LIFO liquidation. But before we go that, we first talk about LIFO reserve. So what is LIFO reserve? It's actually a way of presenting LIFO method cost of goods sold or inventory. In other words, inventory account balances on the LIFO for external reporting and income taxes need minus the inventory account balance on the FIFO or average use to maintain the internal records. LIFO reserve is actually is a difference between using LIFO to report inventory minus using FIFO to report inventory. So the LIFO reserve, which is a LIFO allowances, we call it representing a contra account to adjust the balance of inventory from the internal method to the LIFO method for external reporting. In other words, when you tell everybody outside of firm using LIFO, you need to report a FIFO or average cost and then adding the LIFO reserve to show how much is under LIFO circumstances. And why the reason that you say that, okay, so why don't I just stick with LIFO? Why do I need to use a FIFO internally? There's a couple reasons. First of all, it's a very high cost to keep a FIFO. Okay. Second, there's a contractual agreement such as a bonus and a profit sharing plans that need you to calculate net income based on the FIFO rather than LIFO. Because think about the people paid bills based on bonus and profit. By using LIFO, they have very low net income, hence that their bonus plan and profit plan will be affected by a accounting choice, right? Hence that you have to report on the FIFO method to give money to those people. But externally, because you want to save tax, you report a LIFO method. So that's why you have to keep both records. And then sometimes using FIFO or average costing for pricing decision, because you wanted to somehow make sure your price is most closer to the reality of the cost. Using LIFO, you might come up with a number that is too high. The costs are too high. Hence, you keep FIFO records. Okay, so let's give you an example. The DoubleTree Corporation began 2021 with balance of $475,000 in its LIFO reserve. So it's choose a LIFO, and then there's a lot of money in the LIFO reserve already. So this balance means that at the beginning of the year, the inventory balance on the LIFO method is $475,000 lower, right, than it would be on the FIFO. By the end of 2021, assume that the difference between LIFO and the FIFO inventory balances is then $535,000. The LIFO reserve is adjusted to reflecting the increase in the reserve. So we know that if the price is rising, right, so that means the LIFO inventory is much smaller than the FIFO inventory, right? Because the FIFO left the latest layer and the LIFO leave the earliest layer. Earliest layer is much cheaper than the latest layer. Hence that on the FIFO method, you will have a much higher inventory cost, inventory left than LIFO. So LIFO reserve is this 475 means that if you report it on the LIFO, your cost of inventory is $475,000 less. And then after 1 year, this reserve grow to 535. That means the LIFO reserve is adjusted to reflecting the increase in the reserve. Means that if you 1 year later under LIFO is the $535,000 even less than the FIFO method. So the LIFO reserve has a normal credit balance because if you report inventory under FIFO method until you have a debit side balance, because you want to reflecting what should be on the LIFO, hence the LIFO reserve will have a credit side balance that reduce the number on the left hand side, right? So the entry increasing the balance will consider as the debit cost of goods sold and credit the LIFO reserve. Why debit cost of goods sold? Because under LIFO method, until we sold the higher cost first. So therefore, if you recorded the inventory under FIFO, that means you are short counted the cost of goods sold. Hence, to adjusting to LIFO, you need to increase in cost of goods sold and then park the credit side on the LIFO reserve for $60,000, right? Okay. I will talk this more details in the class as well. Hence that illustration 8.10 provide a disclosure note of Maction Corporation. The note shows that the company's inventory valued at the FIFO internally and LIFO externally reported in the company's balance sheet. So what it looked like is the inventory on the FIFO is 16 million, but they actually creating a LIFO reserve, which is they show the net inventory of 15 million. So this LIFO reserve, in other words, this company choose LIFO method, but under requirements, they have to report a FIFO and then report a LIFO reserve to show what is the real number in the end of under LIFO method. In other words, in 2017, the LIFO reserve, right, is actually decreased from 1,012 million to 5 million. The $7 million decrease is recorded with a debit to LIFO reserve. At the same time, we decrease the cost of goods sold, thereby increasing report profit. So then the question is, why did the LIFO reserve can be on the debit side to reduce the cost of goods sold? Then that's we are talking about. There's a scenario about a LIFO liquidation. So in other words, on the LIFO, the last unit purchase are assumed to be the sold first, but in some period, the number of units sold is actually greater than the number of units purchased, right? In this instance, the previous year's layer of inventory are recorded as sold. So in other words, if you purchase a lot of stuff, like let's say layer 1, layer 2, layer 3, right? You always purchase, you will sold this one, sold this layer, and then second year you keep this layer. Okay, so you sold this 2 layer all the time, LIFO, and then you leave this 2 layer at as ending inventory. Okay, second year you purchased and then you sold them, right? You sold and then I wipe it, and then second year you purchase again. You purchase again a lot. And then, however, this time you sold a lot. You sold this, and you actually erosion the earlier layers, right? So in other words, for instance, that the previous year's layers are sold, and then that means that if this layer is $1, this layer is $2, but this dollar is $100. This one is $110. So you sold more than you purchased. So these are your purchases. And then the solding portion is actually this. You sold all the new purchase on the LIFO, and you use our early layer at a $2 layer. Hence, you will resolve a much higher. We call this sold layer. We call this early layer as a LIFO liquidation. And LIFO liquidation result in old costing being matched with the current selling price, right? Because the price is going up, your cost goes up, hence your sale price, the units. For example, in early years you sold at $5 a unit, but because later years you will sell, let's say, $150 a unit. I give an extreme example, but if you happen to have a liquidation, that means you will sell at $150, but your unit price is only $2, right? Hence that this means that without the old costing being matched with the new selling price, let's say $150, old cost is $2. And then if cost has been increasing, right, and the LIFO liquidation will produce such higher net income, that means that your net income is going to be $150 minus 2. It's much higher. It's like abnormally high. It's gonna be 148. So that's what I meant. LIFO is only temporarily save tax, right? And then is actually deferred tax liability. In the LIFO liquidation scenario, the tax under this scenario is pretty high. It kind of catch up what you saved, right? So let's look at an example. So National Distribution Inc. uses LIFO inventory method. The company began the year with inventory of 20,000 units that cost $16 a unit, and then during the year, 30,000 was purchased at $20 a unit, right? And the cost of goods available for sale is 20 units at 16, 30,000 units at 20. So what happened is that, of course, your goods available for sale is 920 at 50 units, 50,000 units. By the end of year, there's only 45 units was sold on the LIFO assumption. The cost of goods sold is determined like this. It's definitely sold every layer of the 30,000, and its erosion a beginning layer of 15,000. Hence, that the cost of goods sold is going to be 840,000 and the 45,000 units. The ending inventory is 80,000, 55,000 units left. Okay. So remember, cost of goods sold is this much, and your inventory is actually left at 80,000. What if? Okay, I just wanted to give a reasonable assumption. This means that you purchased 30 units and you sold 45, right? Means that you sold the latest layer at the same time you using early layers. What if you actually purchased 45,000, let's say, and then you sold 45,000? Hence, that your cost of goods sold, if you're 45,000 multiple 20, is going to be 900,000, right? So if you purchase equals selling the last layer, that means that your cost of goods sold should be much higher than 840, should be 60,000 higher, right? So that means that your tax saving, let's say tax is 25%. So your tax saving comparing you purchase similar as you sold versus you purchased less than you sold is about so this is about $15,000, right? $15,000. This is $15,000, or this $15,000 is the tax that you pay less if you purchase exactly same as you buy, right? But in other words, this 15,000 tax is what you pay more if you are erosion experience the LIFO liquidation, right? In another word, your net income is increasing. After tax net income is increased $45,000 because the 60,000 minus 15,000 is 45,000 if you experience the LIFO liquidation, right? So in other words, that you have to disclose that this $45,000 increasing of net income is due to after-tax net income is due to LIFO liquidation. So in nutshell, if I bought a similar if I bought 45,000 units at 20 and I sold 45,000 at 20, that means my cost of goods sold should be 900,000, and then that means my net income should reduce my revenue should reduce 900,000. But because I only purchased 30,000 and I sold 45,000, so that's 15,000 coming from a cost layer of a much older layer. Hence, my cost of goods sold become much smaller, become 840,000. So therefore, the $60,000 is going to be contributing to my bottom line. And then this bottom line is before tax. And after tax, if I multiple 1 minus 25%, that means the $45,000 of income, net income increases. After tax net income increase is not because my sales changing or my profitability structure change. It's all because LIFO liquidation. Okay. So therefore, LIFO is not a method that can save your tax forever. It's a method that defers your tax payment. Okay, so now we wanted to talk about what is the inventory management system, right? So the inventory levels has to be closely monitored to ensure that the inventory needs to sustaining in operation available. Means that you don't want to not have enough inventory, because if your volume per demand is much higher than your supply, that means you're gonna losing a business opportunity to some to other people, right? And also, but you cannot have too much inventory because the holding cost is very high. The warehouse cost is really high. So hold cost of ordering and carrying inventory is very expensive. So that's why you want to monitor the inventory value, not short for sale, at the same time not too much burden, because you want to cap the cost of carrying inventory at the lowest. So therefore, it is a conflict here, right? Company must maintain the sufficient quantity to meet customers' demand, right? And then at the same time, the maintaining inventory is very costly. So therefore, the management science develop tools to use to balance those conflicting objectives. First of all, you use a computerized inventory system, or you outsourcing the inventory component for production, right? And you can use a just-in-time system. And then we want to talk a little bit about just-in-time system. It basically means that manufacturing directly coordinates the production with supplier, and then the raw materials directly go to the production process. In other words, many companies has adopted to a system with inventory management system. JIT system is used by the manufacturer to coordinate production with the supplies, so that the raw material or the components arrive just as they are needed in the production process. And then the advantage is that you can keep very low inventory balances, and also customer demand is quickly met. Like Harley Davidson motorcycle is a company very well known about its customer ordered motorcycles, right? And the many components are used in the production are acquired by Harley Davidson. When the order is placed, then they go to get the raw materials. Hence that they have very low level of inventory maintenance price costs, right? And also they can also meet the demand fairly quickly. And I think the ratio that we're going to talk about in this chapter is also covered the majority of them in the financial accounting. First of all, we wanted to talk about the gross profit, which is the percentage of each dollar available to cover the expense other than the cost of goods sold, and then to providing a profit. In other words, that every dollar that for $1, how besides you cover the cost of goods sold, how much you can go to the bottom line, right? And then so the higher the ratio, the higher markup achieved. In other words, it's basically tell you how much that the cost besides the direct cost of the products can cover the other overheads and maybe what is left over for fixed costs and your profit margin. And then the declining of the ratio can indicating two things. First of all, the company is unable to offset rising costs, right, and corresponding increase in the selling price, meaning that the cost started being too high. The variable cost of the products is too high now. Hence, you didn't really increasing your selling price to keep your profit margin. Another possibility of your declining of profit margin is because the sale prices are declining, but you cannot reduce your costs. Okay. And the second thing we wanted to talk about, the ratio that you can be used to monitoring investment inventory is called the inventory turnover ratio. It's basically cost of goods sold dividing average inventory. And the higher the ratio, the more effectively the company can managing their inventory. The declining the ratio is unfavorable to the company, because this ratio shows the number of times the average inventory is sold during a reporting period. And because LIFO is such costly method, because not only you have to keep FIFO and then you have to also translate into LIFO, right? So that's why, and then you have to creating a LIFO reserve. And so when a company has a numerous individual units inventory, it's really hard to calculating LIFO method. And then also when the units cost changing often during a period, it's also very hard, especially you're under perpetual system. And it's very likely that sometimes your purchase is less than your sales units, and then you might run into situation that you have a LIFO in liquidation, right? So therefore, there's a couple techniques to simplify LIFO. One is called the LIFO inventory pool, and one is called the dollar value LIFO method. And LIFO inventory pool is trying to grouping inventory units into pools based on physical similarity and individual units. And then within the pools, all purchased during a whole period are considered as having been made at the same time at the same cost. It's basically treating, let's say if a period means 1 month, okay, treating all that month's purchases into a same price. It's almost like an average system combined with LIFO methodology. And inventory units are converted on an average cost for the pool if the quantity of ending inventory for the pool is increases, right? So the ending inventory will be equals to definitely the beginning, because LIFO always keep the beginning intact and then sell the newly purchased, and then hence the ending inventory is definitely equals the beginning inventory plus a single layer added during the period at the average cost. You treat it as a single layer because there's so many cost purchases. So you put together a period that you feel more comfortable to trace. Then you just mush everything together, calculating an average cost for the whole period, and then use that as the latest cost layer, right? So for example, Diamond Lumber Company has a rough cut lumber inventory pool that includes in 3 types: pine, oak, and maple. And then the beginning inventory consists as the following: 98,800, and then there's a 40,000 board feet, and then pine, oak, and maple, distributing this way. So the average cost of this pool is 2.47 per board foot, because you use the cost of 89,000 divided by 40,000, it's got a 2.47. And during next reporting period, let's say a quarter, Diamond purchased 50,000 board feet of lumber, and Diamond sold 46,000 board feet during this period. So in other words, the 50,000 new purchase, right? It has so many different kind and different costs, but we know that its total cost is 127,000. Hence, that the average cost of this pool, we call the cost pool, is gonna be 127,000 dividing 50,000, and it's gonna be 2.54. And under LIFO method, we know that LIFO, if you purchase 50,000 and then you sold 46,000, that means you left in this pool, you left 4,000, right? Hence you will use the beginning inventory of those 40 board feet at 2.47 feet, plus this 4,000 new pool left, multiple 2.5, and then hence that your ending inventory is this much. Okay, So basically, you're trading, instead of trading individual per unit per foot, you're creating the whole purchase over this reporting period as average, right? And then you figure out how much left, and then you use the beginning plus the left, and then figure out your ending inventory. Okay, so I believe chapter 8 is relatively simple. The only new knowledge I believe is LIFO reserve and then LIFO liquidation, right? Uh, I brought this up because these two things are most related to the calculation mechanical. And other than that, I think the new knowledge is the factors incorporated into inventory costing choices, right? Yeah, in other words, what make people choosing LIFO over FIFO, and the new knowledge it could be the last LIFO pool, right? But the LIFO pool, and I will not test you on that because it's relatively not that important. But the most important thing is that do you understanding LIFO FIFO method inside out, right? And then do you understand perpetual versus periodic, right? So I believe the inventory, this chapter, the journal entry is not that demanding. The most important and interesting part is LIFO reserve and FIFO reserve, LIFO reserve and LIFO liquidation. This is the hardest component that I will maybe spending more time to explain in the class. Okay, so I will see you guys in the class, and I hope you have reviewed this chapter, and I will talk to you guys in chapter 9.